Hello everyone, and welcome back to Market Minute. It's great to have you with us today as we dive into one of the most talked about companies on the planet. If you enjoy getting clear, simple insights into the stock market and what drives the biggest names in tech, make sure you hit that subscribe button. We're here to help you understand the forces shaping your investments and the world around us. Today, we're putting a giant under the microscope. Meta platforms, Facebook, Instagram, WhatsApp. But there is so much more happening behind the scenes that savvy investors need to know about. Meta has been making headlines recently, and for good reason. The company just released its latest earnings report, and the numbers have given Wall Street a lot to think about. Beyond the immediate financial results, there's a bigger story unfolding. This is a tale of transformation, driven by massive investments in artificial intelligence and the foundational infrastructure needed to power it. We are going to explore what these big bets mean for the company's future. Is Meta positioning itself to not just compete but to dominate the next era of technology? We will look at the evidence and see what it suggests for the road ahead. In this deep dive, we will break down everything you need to know in simple, easy-to-understand terms. When most people hear the name Meta, they immediately think of scrolling through Facebook or posting photos on Instagram, and that's completely understandable. These platforms form the core of what the company does and are the primary way it connects with billions of people every single day. The family of apps is an advertising powerhouse. It generates almost all of the company's revenue by allowing businesses to reach a massive, engaged audience. This advertising engine is incredibly profitable, but to truly understand Meta in 2025, you have to look beyond the social media feeds. The company has a much grander vision. CEO Mark Zuckerberg is steering the ship towards what he believes is the next major computing platform, the metaverse and artificial intelligence. This isn't just a side project, it's a fundamental shift in the company's identity and long-term strategy. They are investing tens of billions of dollars into research and development. Artificial intelligence isn't just a buzzword at Meta, it's rapidly becoming the central nervous system of the entire company. For years, AI has been working behind the scenes, personalizing your news feed, recommending content on Instagram, but the recent advancements in generative AI have kicked things into a much higher gear. Meta is now deploying AI in ways that directly improve user experience and, more importantly for investors, drive advertising revenue. The company's AI models can now create more engaging ad formats. One of the company's most significant projects is its open-source AI model, Llama. By making its powerful AI models available to developers everywhere, Meta is fostering a global community of innovation. This strategy does two things. First, it accelerates the pace of AI development as thousands of bright minds work to improve and find new uses for the technology. Second, it positions Meta as a leader and a key partner in the broader AI ecosystem, similar to how Google's Android became the foundation for the mobile world. The investment in AI is also directly tied to making Meta's platforms more compelling for its users. The company has rolled out AI-powered assistants and creative tools across its apps. These features are designed to keep users engaged for longer periods, which in turn creates more opportunities to show them relevant ads. It's a virtuous cycle. From an investor's perspective, this heavy spending on AI is a long-term bullish signal. It shows that Meta is not content to simply rest on its social media dominance. To power a revolution in artificial intelligence, you need an incredible amount of raw computing power. Meta understands this better than almost anyone, which is why the company is in the middle of a massive spending spree to build out its next-generation data centers. These aren't your typical server farms, they are sprawling, state-of-the-art facilities designed specifically for the intense demands of training and running advanced AI models. The company has explicitly stated that it plans to increase its capital expenditures, with a significant portion of that budget dedicated to servers and data center construction. This infrastructure is the physical foundation of Meta's future ambitions. Think of the AI models like Llama as the brilliant minds, and the data centers as the powerful bodies they need to operate. Without this physical hardware, the AI would just be code on a screen. The company is acquiring hundreds of thousands of high-end GPUs, the specialized chips from companies like NVIDIA that are essential for AI computations. This level of investment is a huge moat, or competitive advantage. Building a global network of AI-ready data centers costs tens of billions of dollars and takes years of planning and execution. This creates a significant barrier to entry for any potential competitors. Few companies in the world have the financial resources and technical expertise to replicate what Meta is building. For investors, these capital expenditures might seem alarming at first glance, as they can temporarily reduce free cash flow. However, it's crucial to view this as an investment, not just a cost. Now let's turn our attention to the latest earnings report, which is what sparked all the recent conversation about Meta's stock. The headline numbers were impressive. The core business is performing exceptionally well. The company reported quarterly revenue that beat Wall Street's expectations, demonstrating strong growth in its advertising segment. This is a critical signal for investors. Meta's platforms remain a top choice for advertisers looking to reach a global audience. The consistent growth in the main revenue driver provides a solid foundation. Digging a little deeper, the report revealed healthy growth in user engagement across the family of apps. Daily active people, or DAP, a key metric that measures how many users interact with at least one app each day. DAP continued to climb. This is vital because more engaged users mean more opportunities to display ads. An increase in this metric tells us people are still finding value in Facebook, Instagram, WhatsApp. Another key takeaway was the company's commentary on ad pricing. The number of ad impressions served increased significantly, and the average price per ad showed stability and signs of improvement. That's a powerful combination. More ads and better pricing. This efficiency is partly driven by the AI improvements we discussed earlier. The AI is getting better at delivering ads that users actually respond to, which makes advertisers willing to pay more, boosting Meta's revenue and profitability. However, the report wasn't just about the good news. The company also updated its guidance for future spending, reaffirming its commitment to high levels of capital expenditure for AI and for the metaverse. While top-line revenue growth is important, savvy investors always look at the bottom line, profitability. And in this area, Meta's recent earnings report delivered some very positive news. The company's operating margin, a key measure of how much profit it makes from each dollar of revenue, showed significant improvement. This indicates that Meta is becoming more efficient. Even as it invests heavily in new areas, it is managing the costs of its core business effectively. A rising operating margin is a strong sign of financial discipline and excellent management. Earnings per share, or EPS, is another critical metric that investors watch closely, and Meta's EPS figure comfortably surpassed analyst estimates. EPS essentially tells you how much profit the company generated for each outstanding share of its stock. A strong, better-than-expected EPS number is often a powerful catalyst for a stock's price. As it directly reflects the company's ability to create value for its shareholders, the company also continues to generate a massive amount of free cash flow. Free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures. This is the money that can be used to reinvest in the business, buy back its own stock, potentially even pay dividends in the future. Furthermore, the company has been using some of this cash to execute a significant share buyback program. When a company buys back its own stock, it reduces the number of shares outstanding, which in turn increases the earnings per share for the remaining shares. This is a direct way of returning value to shareholders and signals that management believes the stock is undervalued. After a major company like Meta releases its earnings, financial analysts from big investment banks and research firms rush to update their models and issue new recommendations. The consensus among Wall Street analysts following the latest report has been overwhelmingly positive. Many have reiterated their buy or outperform ratings on the stock. Several have even raised their price targets. A price target is the price at which an analyst believes the stock will be trading in the next 12 to 18 months. The upward revisions suggest that experts see more upside potential for Meta's stock from its current level. The main theme in these analyst reports is the successful execution of the company's AI strategy. Analysts are impressed with how quickly Meta's AI investments are translating into tangible results, particularly in boosting advertising effectiveness and user engagement. They see the AI-powered recommendation engine as a key competitive advantage that is driving growth in platforms like Reels. Commentary from firms like JP Morgan and Morgan Stanley has highlighted that Meta's AI is creating a more compelling product for users and for advertisers, which should lead to sustained revenue growth in the coming quarters. Of course, analysts are also paying close attention to the spending. While the high capital expenditures are a point of discussion, most view it as a necessary and prudent investment in the company's future. They understand that leadership in the age of AI will require massive upfront costs, and they see Meta as one of the few companies with the financial strength to make these investments. The narrative is shifting from Meta is spending too much to Meta is wisely investing to secure its long-term leadership position. No discussion of Meta's future would be complete without talking about Reality Labs, the division tasked with building the metaverse. This is by far the company's most ambitious and controversial project. Reality Labs is responsible for developing everything from the Quest virtual reality headsets, underlying software, social platforms for a future immersive internet. This is Mark Zuckerberg's ultimate vision, a world where we can interact in three-dimensional space, not just on two-dimensional screens. It's a bold, multi-decade bet on what comes after the mobile phone. From a financial perspective, Reality Labs is currently a significant drain on the company's profits. The division loses several billion dollars every single quarter, and losses are expected to grow as R&D spending continues. This makes many short-term investors nervous. They see the huge losses and question whether the metaverse will ever become mainstream. The risk: Meta could spend tens or hundreds of billions on a project that fails to gain traction. For long-term, growth-oriented investors, Reality Labs is a massive call option on the future. If Zuckerberg is right and the metaverse becomes the next major computing platform, Meta could dominate it. Having built the hardware, the headsets, and the key software platforms, Meta could become the Apple or Google of this new era. The potential market could be in the trillions of dollars: gaming, entertainment, remote work, social interaction. The investment thesis requires patience and tolerance for risk. Investors must believe in the long-term vision and trust management's execution. Meanwhile, the core advertising business is a strong safety net. Profits from Facebook, Instagram fund Reality Labs' losses while leaving cash for share buybacks and other investments. Putting all the pieces together, a clear picture emerges of why Meta could be a very strong investment for the long term. The company has a three-pronged strategy for growth that positions it to lead in the next era of technology. First, it is optimizing and protecting its incredibly profitable core business, the family of apps. By using AI to enhance user engagement and to boost ad performance, Meta is keeping this cash cow profitable for years to come. That stability provides the foundation and gives the company immense financial strength and resilience. Second, Meta is aggressively investing to become a leader in artificial intelligence. This is not just a defensive move, it's an offensive strategy to build a lasting competitive advantage. It's developing powerful AI models like Llama and building massive data center infrastructure to run them. Together, those investments create a technological moat that's hard for competitors to cross. Third, the company is making a bold, visionary bet on the metaverse through Reality Labs. While it's the riskiest part of the strategy, it also offers the greatest potential reward. If the metaverse becomes the successor to the mobile internet, Meta's early massive investments could pay off exponentially and create a new multi-trillion-dollar market. This multi-layered approach makes Meta a compelling long-term contender. An investor in Meta today is buying into a stable, profitable advertising giant, an emerging AI powerhouse, and a speculative but potentially revolutionary metaverse pioneer. The company is not just sitting back, it is actively using its resources to build the future. That forward-looking orientation combined with proven ability to execute at scale is why many believe Meta's stock has a long runway for growth ahead of it. So, what is the final takeaway for you, the individual investor? Meta Platforms presents a fascinating case. Recent earnings show the core advertising business is healthy and thriving. Ad performance, rising revenue and engagement, relentless user engagement driving ad strength, increasingly sophisticated AI powering better ad targeting and monetization. This creates a powerful and profitable engine in the here and now. That engine's financial strength is undeniable, generating vast amounts of free cash flow. That cash gives Meta a huge strategic advantage. This is the bedrock of the investment thesis: stability. Meta is aggressively investing that cash into two major trends of the next decade: artificial intelligence, the metaverse. The spending is enormous and it introduces risk, but that spending is building a formidable competitive moat. AI investments are already paying off, strengthening the core business. Metaverse work is a longer-term play. It offers potential for transformative growth. It could dwarf the company's current scale if the vision comes to fruition. For long-term investors who believe in technological progress, Meta is a unique opportunity. There will be volatility, but the strategic direction is clear. Ultimately, the decision to invest is yours alone. We hope this breakdown gave you a clear view of Meta's moving parts. What do you think about the massive spending on AI and the metaverse? Brilliant move or risky gamble? Let us know in the comments. If you found this helpful, please like and subscribe to Market Minute for more deep dives. Thanks for watching, and we'll see you next time.